One of the most important interest rates in the U.S. economy is the federal funds rate. Because of its effects on inflation, economic growth, and employment, the federal funds rate has a significant impact on the broader economy. If the Federal Reserve wants a tighter monetary policy to fight inflation, the Fed will raise the Fed funds rate. Conversely, the Fed will lower the rate if it wants to help stimulate the economy or avoid a recession. The federal funds rate is the interest rate banks charge each other to lend excess reserves overnight. Banks are required by law to have a minimum reserve level in proportion to their deposits. When a bank needs to meet the reserve requirement, it borrows that money from other banks that have excess reserves as one of its tools to set the nation's monetary policy. The Federal Reserve, through its Federal Open Market Committee, determines the federal funds rate. The Federal Open Market Committee, or the FOMC, is a branch of the Federal Reserve System made up of Federal Reserve Bank presidents and the Board of Governors. The FOMC meets 8 times per year to direct its open market operations. The direction of interest rates and monetary policy are determined through these open market operations. When the Federal Reserve changes the federal funds rate, interest rates throughout the economy will tend to follow in the same direction. Banks use the Fed funds rate as a basis to set their prime lending rate. The prime rate is the interest rate charged by banks for its loans to its most credit-worthy customers. The prime rate affects loans, from commercial or business loans to home mortgages and short-term consumer loans and credit cards. Bank deposits are also affected, as the savings rate also changes along with the Fed funds rate. Investors pay close attention to the FOMC meetings because of how it affects the stock market. Currency markets are also affected. Rising interest rates will tend to make the US dollar stronger relative to other currencies. Since a rise in interest rates can attract investors seeking higher yields on bonds and other investments that pay interest, investment capital from other countries will increase demand for the US dollar, thereby raising the value of the US dollar relative to other currencies. Conversely, lowering the interest rate will make the US dollar weaker versus other currencies. While the FOMC cannot force banks to charge the exact rate as the Fed funds rate, it can serve as a guide for banks as it effectively becomes the target rate at which banks can charge each other for overnight loans. The Fed can use its ability to control the money supply to help reach its target rate by increasing or decreasing the money in circulation. By decreasing the money supply, the Fed can raise the interest rate, while increasing the money supply will lower the interest rate. Subscribe to this channel for videos on the economy and business news.